Hey guys, it's Willie. Today I want to talk about Pepsi. Pepsi's a wonderful consumer staples company. It's international. It's an absolute behemoth. They sell lots of stuff. Everybody thinks about their soft drinks and bottled water and bottled juices and stuff like that. But Pepsi, different from what Coke has been doing, is Pepsi sells stuff like Lay's potato chips, Doritos, Fritos, Tostitos. They also own Quaker oatmeal. So Pepsi's a diversified consumer staples company. They're really wonderful. And it's really a go-to if you're trying to prepare for any sort of stock market crash, recession, downturn, economic headwind, whatever you want to call it. But Pepsi's a go-to. I want to look at some numbers today and see if we think it would be worth buying at its current price to produce a above market return. See if we can get our money's worth if we bought it today at $168. Downturn, economic headwind, whatever you want to call it. But Pepsi's the go-to. I want to look at some numbers today and see if we think it would be worth buying at its current price to produce a above market return. See if we can get our money's worth if we bought it today at $168. Alright, so now that we're in our spreadsheet, first I want to start out with our revenue, our earnings, and our cash flow from operations. Basically looking at the money coming in. So if we look at revenue, earnings, cash flow from operations, they've been climbing, but frankly put, it leaves a bit to be desired, especially revenue. I mean, really 0.5% a year over the past 10 years. That's pretty bad. Earnings, 1%. Cash flow from operations, 1.7%. It's bad, but it's somewhat expected because it's Pepsi, the international behemoth. I mean, there's not many more people that they can sell to that they're not already selling to. Capital expenditures, over the past 10 years, they've grown faster than revenue and earnings. I mean, it's okay. It's not shocking, it's not surprising in any way, shape, or form. It's capital expenditures. So cash flow from operations minus our capital expenditures gives us our free cash flow. Free cash flow has been growing at about the same rate as earnings, about 1% a year over the past 10 years. You're looking at $5.7 billion to $6.4. Again, not stellar growth, but it's Pepsi. It's kind of what we expect. Shares outstanding have been going down, which is at negative 1.36% over the past 10 years. Something I like to see from a company for sure. Shares coming down, then buying them back. However, with Pepsi, I don't quite understand it. Because Pepsi, from my perspective, is an expensive stock from a valuation standpoint. And we'll get to that in a minute with PEs and our IRR calculator. But I think the reason Pepsi is buying back these shares doesn't necessarily have to do with rewarding their investors, which it does do, but I don't think that's their entire motivation. I think it has to do with their dividend. They're paying out a lot in dividends, and so when they buy back, let's see, what is that, about 200 million shares? That's 200 million shares they don't have to pay a dividend on anymore. I think that's the reasoning behind it. I may be wrong. That's just kind of my gut instinct. Pepsi being a slow-growing company, and they're kind of expected to raise their dividend every year. This is one way they can lower the amount of free cash flow that they need to use to pay that dividend, while also raising the dividend that they pay per share. Since there's fewer shares, they don't have to use as much free cash flow, even though the dividend's higher. Moving on, earnings per share, free cash flow per share, growing faster than, the earnings or free cash flow numbers on their own because of these decreasing shares outstanding. We're seeing about 2.5% growth in earnings per share and free cash flow per share. On to debt, where we assess more of the safety of the company. Debt has been growing at 4.3% per year over the past 10 years, which is faster than revenue, earnings, or any of those other numbers. But, we take total debt, you subtract your cash, and you get our net debt. Well, that still doesn't really help us a whole lot because it's still growing really, really quickly compared to earnings or anything else. So it is a bit concerning that it would take, 10, 11 years worth of free cash flow to pay off all their debt. That's a bit pricey. However, this is Pepsi. They've got reliable, stable free cash flow. So I'm not that concerned with the debt level. I would be with a lot of other companies, but Pepsi being Pepsi, the solid consumer staples giant that it is, I think they kind of deserve a pass on this. Return on invested capital, solid low double digits, average of 13.8% over the past 10 years. Really, honestly, that was kind of surprising to me, being over 10% for Pepsi, because, come on, it's Pepsi. But it's good. On to our metrics. So we're looking at our PEs and our price to free cash flow numbers. They're over the level we want it to be at, so this is screaming that Pepsi is expensive, which it is. Net debt, again, 10, 11 years worth of free cash flow to pay off the net debt. Revenue growth, positive. Earnings growth, positive, good. 5-year free cash flow growth. Over the past 5 years, free cash flow has actually dropped. So, there's that, but over the past 10 years, it's gone up. So, I'm less worried about this number. Shares outstanding going down, something we like to see. And a solid return on invested capital of 15% over the past 5 years. Really impressed with Pepsi on that metric, to be honest. A boring dinosaur company having a double-digit return on invested capital. Really good. So now on to our forecast. Free cash flow growth, I said 1%. I said the same thing with earnings. As we can see, that's what they've done over the past 10 years with earnings and free cash flow. I'm not going to assume they continue to buy back shares. You could put in the 2.5%, but I'm going to assume the 1%. I'll run it again with 2.5%, and you'll see what I'm talking about. It really doesn't matter. But price to free cash flow and PE of 15, that's the market average. I think they should get that. One would argue that Pepsi is a defensive company with a really large moat, and they deserve a higher PE. I wouldn't argue on that point. However, others would say that Pepsi has such low growth, i.e. 1% a year, that they deserve a low PE. So I'm just going to fit right in the middle of the two people that are arguing about PE ratios. And I'm going to stick with the market average of 15. Current price, $168. We take our two prices of $76.50 and $85. And we get a price target of $80.63 in 2030. Go to our IRR in at 168. We get these cash flows. A lot of it is a dividend, as Pepsi is known for that. Out at 80.63. You're getting an IRR of minus 3% a year. I didn't expect it to be that low from Pepsi. I expected a low number, but I didn't expect something that low. That was surprising. Even if we go back and say that Pepsi's going to grow at our 2% number, you're still looking at minus 2% IRR, which is not great. And then I think if we put in a 20 PE, which I think is exceptionally high for a company like Pepsi, you break even. So right now I think Pepsi is, I'm not going to say absurdly overpriced, overvalued, but right now I think Pepsi is really expensive, and I wouldn't be buying. I really wish it was cheaper because it is, again, a wonderful, stable, solid consumer staples company. They're not going anywhere. It'd be a really good buy if it was cheap enough. Maybe during the next crash or something like that. This would be a good company, just like Coke and your other consumer staples companies. Would be a good thing to pick up later on during a crash, recession, or anything like that. But anyway, that's the end of this video. Pepsi's just too expensive. Hopefully in the next video I'll find something that is a bit better as far as our IRR rate of return. It's just really hard right now as a value investor to find companies that we think are cheap. A lot of the big companies, especially like S&P 500 companies, a lot of them are overvalued from this sort of value free cash flow perspective. It's just difficult to find anything that even matches the market or would beat the market. Not to say that they don't exist. I mean, Intel is one of them I think is going to solidly beat the market over the next 10 years. But anyway, that's it for this video. Like, comment, subscribe, all that YouTube hoo-ha that you have to do. But I appreciate you watching. As always, I will catch you guys in the next video.